Brian is, you may or not know, but is credited with sort of inventing the ad exchange. Now, we could feel like we want to slap him for that, or can go congratulations. I'm not sure which way, but we're going to find out by the end of the session. Back in sort of 2007, 2006, I think, was that where it started to cook.
Yeah. There were $5 billion of acquisitions in 2007, and so everybody, including me, went off and started an ad tech company and raised a bunch of money. And that's where you get these Lumascapes and these eye charts where there's 2,500 ad tech companies that existed 2 years ago. I think that's actually dropped to about 2,000 now, and we expect that to continue to drop as the market gets more competitive. We're seeing margins compress. I know that everyone is concerned about those burn down charts where a dollar becomes 40 cents. There's a ton of pressure on everyone in the market, from the agencies all the way down through the publishers, to compress that. And so what we're seeing is that that's putting a bunch of companies out of business, which I think is very healthy. But that's really the evolution. Is the success of the ad exchange caused a bubble, and now we're seeing that bubble burst for the ad tech companies. And at the same time, we're seeing this actually start to work for marketers and for publishers, and to see real value being created by this better technology.
So you're going around the world at a frantic pace. Tell us a little bit about, say, what marketers are thinking about in the US versus the UK. Is there any difference? And based on your conversations here, how Australia fits into what is going on globally in those key markets from the marketer side?
On the advertiser side, what we're seeing is a couple of major global trends. One is we're seeing agencies led by GroupM and Xaxis start to really adopt programmatic technology and bring it into the core of their businesses. So things like GroupM Connect, which is GroupM creating a global programmatic business, is really exciting because it means this is something that's going to get real global scale. So that's happening globally. And I'm not sure every holding company has done as good of a job. So I think there's a lot of laggards who I won't name. On the marketer side, what we're seeing is that most marketers are leaning into programmatic. But the US is different because it's such a big unified market that it makes sense for some of the largest marketers to start thinking about bringing some of this technology in-house. So what we're seeing is this is a very, very small number of very large marketers, mainly in the US, who have large internal data sets and large data science organizations who actually think they can leverage this technology for themselves. And so we've been supporting that for a while. So eBay is a good example. Walmart's a good example. American Express has always had a huge data science practice internally and may be able to leverage these technologies. But in general, what we're seeing is that it's only a very small amount of the value provided by that, and that agencies are getting more and more effective at helping big brands bring this in-house by saying in-house to the agency, but keeping all that data and algorithmic work that is the value of the marketer into the agency environment. So that's global. What I've seen here in Australia is that we've seen a few marketers get very, very smart about this and work in close conjunction with their agencies to make programmatic more effective. That's exciting. I'd say that we've seen less of that in the UK. So I'd actually say US, Australia, UK right this second. Yeah, I think you should feel good that you're in a very advanced market, one of the top 3 in the world, and that, especially in this building, we've seen a lot of real forward-thinking adoption of the latest and greatest of programmatic and really effective application for clients. The agency does a lot, and programmatic is still, even though it's growing, is only a small fraction of that. And to say we're going to bring just programmatic in-house really only makes sense if you're really, really big, because it's not operated in a silo in most cases. So for marketers who've brought search in-house over the past decade, search is pretty big. It's a big enough investment that you could say this is going to be a strategic competency for us. For programmatic to be big enough to make it a real strategic competency for a CMO would require it to be hundreds of millions of dollars of spend. It's just an estimate. And so if you think about that, there's only about 10 marketers in the world, maybe 5, who spend that much on programmatic today. And so if you look at the largest in the US, take an AT&T, they run this all through MEC. Even though they know that they're spending, $70 or $100 million, it just doesn't make sense for them to make that a competency. They're spending $2 or $3 billion on marketing, and to take 5% of that and go hire a bunch of people and build this expertise doesn't make a lot of sense. So that's one of the biggest in the U.S. So I think it's a very small fraction that are doing this effectively. Where a lot of marketers are going is they're saying that they're insourcing programmatic. What they do is they outsource it to an ad tech company. So they said, we took this in-house and we handed it to MediaMath or Turn or the Trade Desk, but we're doing it ourselves. And that's just replacing one very aligned agency group for, I would argue, a much more expensive and less aligned organization that exists to make as much money as possible from your spend. It's not an agent. And if you look at the public ad tech companies, you can see their take rates. Rubicon Project takes 26.9% of every dollar they touch. TubeMogul takes between 27 and 55% of every dollar they touch. Criteo takes 40 to 50%. And what I struggle with is,
and AppNexus, by the way?
We're about 9.6%.
Oh, you're cheap.
Well, we believe in trying to get as much money from the marketer to the publisher as possible.
So going back to the big margins, so what's the takeout? What are the implications here? What's going to happen?
Well, one implication is you should pay your agency a lot more because clearly they're undercharging you for the value you're getting. The other is you should be very, very skeptical of every ad tech company, which I can say because I run one and I invest in a lot of them and advise them. This idea that your money should go to them as opposed to the publisher is actually really bad for the internet. And if you think about what makes the internet work, there's this virtuous cycle that connects marketers who fund content to consumers who consume the content and pay for it with the attention that they give the marketers. That's a cycle. And if you see intermediaries taking 20 or 30 or even 50% of the money out of that ecosystem, what you see is things like, hey, Fairfax lays off 130 journalists. That's bad. That's bad for business for everybody. And I think we need to figure out ways to make this whole thing have less friction and put more money back into the principals. And the principals really are the brands and the publishers who create content. And I have no problem if the content's not good if you lay the people off who create it. But I'm really concerned that we end up in a world where BuzzFeed is where we all get our news and that our kids grow up thinking a listicle is an article. And that's a problem for me as a human and also someone who believes in democratic society. We need the free press. We need content to educate us and to actually hold people accountable.
We see some figures around of about 40 cents. I say $1 of every advertiser in programmatic ends up going, 40 cents of it gets to the publisher. There's 60 cents taken through the chain on the way through intermediaries.
I'm kind of a cynic on this topic. So I think that the smartest buyers, so let's take Walmart as an example, one of the largest marketers in the world, one of the largest companies in the world, and their mantra since they were founded was basically, make things really cheap so that we can give consumers a better life. Like that's their basic mantra. And they've brought this into media. They've actually said, we're going to figure out how to make that number 90% or 95%. And so they came to us earlier this year and said, what would it take to get rid of all of that overhead? How could we work directly with publishers and send as much money as possible to publishers? And they actually put a very small team in-house, although you could easily do this through an agency partner as well. And they said, look, go do deals with the 25 biggest video publishers in the US. Let's use programmatic so we can cherry pick the impressions we want, but let's find ways to get the actual cost of that transaction down to below 10%. And they asked us to come in with a very low rate. We already have extremely low rates, and so it was easy for us to do this. And so we've been able to actually execute for them. Right now, the stat is about 87% of every dollar goes to the publisher. Our goal is by the end of the year to get that to about 93%. And that's actually because the publishers are paying too much for ad tech. So the publishers are getting ripped off, to put it differently. And so Walmart wants the publishers to stop getting ripped off. They're actually advising publishers to dramatically cut the rates they're paying ad tech providers. And so that's possible. I'd say the same thing on things like viewability. If you want to get 90% viewability, you absolutely can. The reason we can't is because of all the intermediaries, all the technical complexities, all the things that get between us and what really drives results for marketers. I'm not sure if the GroupM people agree with this, but I think any ad you buy that is not viewable is money you just lit on fire. I'm not saying it has to be viewed. Like if you buy ads in a newspaper or on a billboard, I can't force people to watch them. We tried that, and that society did not succeed. So as a computer scientist, one of the really fascinating aspects of this is we can see the patterns of how people are influenced by ads. This is going to shockingly change your day. We have seen no evidence that people are at all influenced by ads that they don't see. which is shocking. So when you buy these non-viewable ads, one thing that Google does that I don't like is that they will actually, in their attribution methodology in DCM, they give credit for non-viewable ads. So if a consumer sees 3 really high-quality ads on, let's say, a Fairfax publication, and then sees a non-viewable ad on some crappy blog, they will still give credit to the crappy blog with the ad that no one saw. And then, being smart, the media buyer or whoever goes, wow, they're killing it. Let's spend more money on that blog. And so then Fairfax lays off journalists. It's not real. And so we all have to hold all of these people accountable and say, I'm only paying for viewable inventory. I'm not going to pay all these ad tech taxes. And that also implicitly means you can't hire an ad tech company who's charging 15% or 20% of every dollar just for the privilege of working with them, and then expect them to give you 90% of your media that actually works for publishers. So this is common sense, but it does require a really clear focus across the entire ecosystem on we're not paying those fees anymore. We're not paying the Google tax anymore. If you're buying through AdX, you're paying a Google tax. How many Google taxes do you pay on every ad you spend? I've got nothing against Google. I just don't understand how 40 cents of every dollar goes to Google, and we sit here complaining about the other 20%. So these are just small things that I would encourage everyone just to continue to be skeptical about and continue to push, especially GroupM, who's already doing this very aggressively, but anyone you work with, to cut those numbers down as much as humanly possible so that more of your dollar goes to work for you.
When marketers are going, we want to cut the snouts in the trough, if you like, if you want to use that analogy, from 40 cents to wherever it goes, is that there must be a benefit for the advertiser in that as well as beyond the publisher, in that more of their money's going to go to actual inventory or potential to talk to people.
Absolutely. I mean, the bottom line is you're spending money on these billboards facing walls. I mean, if you said, I'm going to buy humans only, I'm going to no longer buy bots because they don't actually buy things, I'm only going to buy viewable impressions, and I'm only going to buy inventory where I can put 80 or 90% of the money to work with publishers, what you're going to find is a dramatic increase in effectiveness. Probably 60 to 100% increase in the effectiveness of those ads. Even if you paid the same amount of money for the ads, you're actually shifting all of that to the highest value, highest quality spots that you can buy. And the economics are interesting, because even if you said, I'll pay twice as much, but I want to buy half as many ads because I'm not buying all the stuff that doesn't make any sense, what you end up buying is a lot more homepage, a lot more high income, a lot more in target, a lot more of the people you actually want to buy. And you can afford a lot more data. You can afford a lot more of the sophisticated algorithmic work, data scientists. Everything you're getting now is high quality, as opposed to buying a bunch of stuff that's wasted. I'm not talking about the 50% of all advertising doesn't work. I'm talking about the other 50% that can't work.
When you talk about maybe paying more for inventory, that goes against the grain, certainly in this market, discussion about the pricing being, value being price rather than impact, for instance, and what you're talking about here. So is there acceptance that you may need to pay more for a quality impression, or people are saying we want it for the same price in those markets where you're seeing this happen?
I think that the trend over the past decade of buying audiences and not buying premium content has been not just bad for the internet, but also bad for marketers. I think we have 50 years of history that says that if you buy the right consumer or the right audience at the right moment with the right message and the right medium, then you get great outcomes. And that medium really does matter. And so if you're saying, I don't care where, I don't care what site the person's browsing, I don't care what their mindset is, I don't care about anything, I just want proof that this hit somebody's eyeballs, I think you're going to be very disappointed. And so it is not a surprise, I hope, to anyone here that the best inventory costs more. And that's not because some salesperson cranks up the price. It's because it works better. And I'm an algorithmic person, so I'm saying algorithmically we see that the best placements actually deliver 5 to 10 times better results than the worst placements. And I'm not saying you should pay 5 or 10 times more. I'm saying you should pay twice as much. And so what you're going to see, just doing the math, is that your actual effectiveness will triple or more when you're buying the right spots. And that's great for the publisher. They get twice as much money. And it's great from a branding perspective because you get 5 to 10 times the impact. And that just means it's not a zero-sum game. We often think of the more I pay, the less I get. And this is not the case. This is a case where it's not zero-sum, where buying the right ads means you can afford to pay more because you're not buying all the stuff that doesn't actually work.
So let's go quickly back to the financial markets, because you were saying earlier a really interesting example of front running, what's happening in our markets. Fascinating. So I'll get Brian to tell the story about, I've got to get the company right, it's got an X in it, that's all, I'll leave you the rest. But tell you the story, and then how do we as non-coders, most of us, I hope, because otherwise I'm really on my own here, but how do we keep up, and what are we supposed to do to keep up with you big brains that are doing all this funny algorithms. So what are we supposed to do as non-coders about that? But start with the example.
Yeah, so we were talking about Flash Boys, which is an amazing book by Michael Lewis about high-frequency trading in the stock markets. And there's this concept that this book talks about, which is front running. So you call your stockbroker, or you go to E-Trade, or whatever you do. And that order, when it's placed, doesn't immediately go to the market. Someone, in theory, could look at what you want to buy. You place an order to buy Microsoft stock for 28 bucks. Front running would be, if I see your order at 28 bucks, I see that the market is at 27. I buy 27 and sell to you at 28. So I make $1. Now, you could say, I said I was willing to pay up to 28, so I wasn't harmed. But if you think about that from a consumer perspective, every one of the grandmothers who's going in to buy Microsoft stock is paying $1 more than she had to. And so this is a great example of where Walmart was effectively, taking money away, where Wall Street,
yes,
money from Main Street. Sorry, it was not Walmart doing that. So anyway, that's a classic case of front running. And high frequency trading allows you to do this very effectively. So if you can get your order in first, you can basically cherry pick all of these orders and just print money off everybody else.
And essentially, speed gave them the visibility. That's
Exactly.
how it works.
They're so fast they could do this. So what's really interesting is in our world, we've actually seen an example of this recently, where one of the SSPs has inserted JavaScript code onto website pages to watch all of the real-time bids that come in. And then, once they see all the market demand, they increase that by a penny, and they submit the bid back down to the publisher. And then they capture the difference between the market rate and what they're paying the publisher. And we're guessing that they're making 20 or 30 cents CPMs, basically just by front-running the real-time bidding market. So on one part, I'm like, wow, kudos. Like, that's really, really smart. Like, you totally found a way to
game
money.
it.
You game the system.
Yeah.
But if you think about it, that means the publisher's making 20 or 30 cents less than they should, and every marketer is paying 20 or 30 cents more than they should. And, it's absolute friction in this system. And so one of the questions we were talking about is, well, how do you stop this? And so one way is I could tell you all the name of this company. They do have an X in their name. And we could shame them, and you could all tell your agency, don't buy from them. The problem is that the same engineer who came up with this idea will just go to a different company and do it again, and do it again, and do it again. So maybe we should go make a big to-do in the media about this. Well now, because it's complicated, most of the reaction we expect would be that people are going, I'm not going to buy from exchanges, it's too complicated, I don't trust them. It's not going to be to stop buying from this one bad actor. So, even better idea, how about governmental regulation? Because that always solves this kind of thing. I will quit. So, what's left really is for us to do more surgical things. So next week, AppNexus is rolling out a feature that will anti-front run markets. So we detect it. When we see the same ad being sold for 2 prices, we will always buy at the cheaper price, which means if they increase the price by even as little as a penny, we will detect it, and we'll always buy around the front-running player. Now this is actually possible in our world because there is no regulation. To do this in the stock market requires actual regulation to change the way the markets work. In our case, we can just say, hey, we're a buyer on behalf of Xaxis and Connect and all the rest of our buyers. We're no longer going to buy that penny increased price. But we're constantly fighting this interesting fight of all the different ways people can find to make money. And I can tell you story after story of techniques that people are using to try to get advantage. Some of those are on the buy side, where we've seen some sneaky activities to sort of cheap publishers, which work for a short time until they're caught. And we've seen some like this where it's trying to get extra money from buyers. But it's a pretty exciting and dynamic market. To the second half of your question, how all of you can operate, you don't need to know the details. What you do need to do is what Michael Lewis did, really, which is to ask a lot of questions and just say, explain how it works. How do you know this auction is fair? How do you know that the best price is winning? How come when I'm bidding $10, I'm always paying $9.99? Shouldn't this be a second price auction? Shouldn't I be paying $3 or $6 or whatever? These are questions that all of a sudden yield revelatory outcomes. You don't have to understand the details. The other option is to choose a partner, which I would love for you to work with AppNexus, through GroupM or through Xaxis, because we do focus on these things. But to choose a partner that you trust to ask these questions on your behalf. And so, here in Australia, you've got extraordinary people on both sides, and I think you can trust them to be asking these questions. I only know this because 2 days ago I was here and they were grilling me about all of these things. But I think that skeptical mind, or the beginner's mind here, is really what you bring. And you can leave the coding and details of this to the engineering folks, but they need to represent your interests fully.
The consolidation in trading exchange, or consolidation in the programmatic sector, that's coming. You've already talked about the bubble bursting. What about what's going on in distributed content or the platforms, Google, Facebook, and so forth?
It's really a consumer question for me. Will consumers continue to search? Will YouTube be where people post free videos of themselves? Will Facebook and WhatsApp and Instagram be where consumers spend their time? Will Facebook write a $160 billion check to buy Snapchat? Or will Snapchat become the new empire? In 5 years, we might be thinking of Facebook the way we think now of MySpace. But we may all use Facebook Messenger to buy everything online because that's the new web browser. So all those things mean that whichever companies control consumer attention will control marketer dollars. So the different lens of that as marketers is to make sure that we're looking across all of these channels. You don't want to overinvest in Facebook. You don't want to overinvest in search only because that's not where all the consumer behavior is, and you need to find ways to at least hedge your bets, but also to make investments in where we think consumer behavior will be over the long time. Just since I've been here, you saw the newspapers here in Australia, merging their revenue data to say, hey, we still matter. Like, newspapers are still big. I think that's actually true, is they're big and they matter, and we want to make sure we're fairly allocating, if not over-allocating, to interesting sources of media that will survive. And don't forget that Facebook doesn't produce content. They're getting their content from all of these publishers. And so that's actually important, is you may be finding your viewers on Facebook, just like you're finding your viewers on the web, but it's still the same content produced by journalists, produced by these big publishing houses. And I think that's important for all of us to remember as marketers is, it's the connection of eyeballs and content. And if that happens on the web or on an app or on Facebook or in Messenger, we just have to find the right creative to address them and the right technologies to use to find the right people at the right time to get our messages across.